And that does it for today's rally that we saw on the street. Dow, S&P, and NASDAQ all ending firmly in the green. The NASDAQ up, look at that, over 3%. Dow up 750 points. The S&P up just over 2.7%. On a sector basis, all 11 of the S&P sectors closing in the green today. The outperformance that you're seeing in the NASDAQ has a lot to do with the rally that we saw in some of those larger big cap tech names, Apple, Amazon, Google, among the biggest gainers today. Well, for more on today's market action, we want to bring in Dory Wiley, Commerce Street Capital President and CEO. We also have George Ball, Sanders Morris Harris Chairman. George and Dory, great to see both of you. Dory, let me start with you. This massive rally that we saw, obviously you could make the argument that we were due for a bit of a bump, but what's your takeaway from the buying that we saw today?
Well, I think that's as good an excuse as any. Is sentiment was looking for something to be positive about, and we were due to bounce off the bottom. We've had positive earning numbers for a while. Corporate earnings have been hanging in there. I think probably, and then you had housing starts give us a bad number today. But if you look at, I think the market just got very optimistic. Saw the dollar come down and the potential for, the 50 basis point hike in the ECB on Thursday, and less likelihood of a 100 basis point hike by the Fed next week.
George, as you see it, what did rally these markets? And to Shauna's point about the big tech names, what do you make of that?
I think Dory hit the nail on the head, or at least part of the nail on the head, when he said that the 100 basis point possible Fed hike was a canary that died. And when people saw that died and that the Fed is going to increase rates by 50 or 75 basis points instead, there was a sigh of relief. And after 4 consecutive weeks of down markets, there was a relief rally that was no, we're not going to tighten things so much that we're just going to create an enormous recession no matter what. The Fed is going to tighten, but only modestly, and I feel better than I did yesterday. And that's 700 Dow points.
I mean, and that's a very different swing that we saw from what we saw yesterday with the markets ending very negatively. So, Dory, we're also seeing oil prices edging above $100 a barrel once again. Is that signifying anything to you about what we can expect going forward?
Well, the oil market's been kind of strange lately. Every time we get these words of a recession or softening demand, and oil's been going down, the oil stocks have been going down. We've been very consistent in our message that it's a supply problem, not a demand problem. So when that happens, that's a buy signal. So I think oil is going to continue to remain very, very strong, despite whether we have a recession or not. And we've been arguing that we're in a recession. Question is just how bad is it going to be?
George, what do you think about the prospects of whether or not we're in a recession and the likelihood that we would see one over the next couple of months?
Most people at this point are acceptant of the fact that we're going to see something that is a recession light over the next 6 months. Whether we're in one now in a technical sense or it happens in 2023 really doesn't matter. I think what's a positive in terms of being a floor under the market is a recession is not going to be a category for hurricane. It's going to be a tropical storm. Tropical storms are annoying. They cause tree limbs to fall and cause power to flicker out for a bit, but it's not a catastrophe. There is very strong consumer underlying demand. And if the Fed eases us toward higher rates, but doesn't just create something that is a show ender for borrowing and for consumer spending, we're going to see a small recession. That's actually all right. It's been a decade since we've had a recession. They happen now and then. It's not the Fed's job to keep us out of a recession, nor can they forever. So I think there is downside left in the market. The markets are more apt to end up lower this year as opposed to higher, but nothing catastrophic and nothing that should cause an investor to dramatically shift courses.
Okay, George and Dory, I want you guys to hold on real quick. We need to get to some breaking news. Netflix is out with its earnings report. Shares popping here after hours. Ali Canal, what are the details?
Hi, Shauna. Yeah, shares are reacting positively due to Netflix beating those subscriber estimates. Netflix previously anticipated a loss of 2 million subscribers in Q2. That loss was a lot less intense. 970,000 is the loss that was experienced in Q2. For revenue and EPS, that came in mixed. Revenue missing $7.97 billion versus the expected $8.05 billion. Adjusted earnings $3.20 versus estimated $2.98 expected. Now, Netflix's Q3 subscriber guidance of 1 million did come in below Wall Street's consensus estimate of 1.9 million, although analysts, they have admitted that the second half of the year could see potential downside risks amid that macroeconomic concerns, inflation, foreign exchange pressures, just to name a few. Now, a few questions that I'm going to be looking out for on the earnings report. Ad supported. Why did Netflix choose Microsoft as its partner? How much will this tier cost? And realistically, when will this roll out? Are we still on track for that Q4 timeline? Because I think investors and analysts really want some more clarity there. I'll also want an update on that password sharing crackdown that it's testing overseas. How is that working? When can we expect it to hit the US? And finally, I'm going to want further context and analysis on the strategy behind its content and marketing spend. Netflix does plan to spend $17 billion on content alone, but it feels like some of those bigger titles need some more love on the marketing front. So really how to finesse that area of the business, considering Netflix has had 4 different CMOs in the last 3+ years. So those are my top questions, but obviously a lot more to discuss here. But right now, investors are certainly rewarding Netflix for that beat on subscribers in Q2. Shauna?
All right, Ali, thanks so much. Again, shares popping here after hours. We're going to be discussing a little bit more about these earnings in next block with Santosh Rao. Dave?
All right, let's get back now to our guests, George Wiley and George Ball. Dory Wiley and George Ball, good to see you both back with us now that you've had a chance to hear a little bit of those Netflix earnings. George, what's your big picture reaction there?
Number one, the speculators are the ones that are kicking the stock up 5%. A million person loss in subscribers as opposed to 2 million is probably better, I guess, by half or by a third, depending on how you do the math. But it's not particularly encouraging. More and more investors are looking at not today's earnings, but those likely over the next couple of quarters. So I think their actual conference call will be telling. Speculators like anything that's good or bad, that they can jump onto a 5% increase in the price of the stock because the subscriber loss is 1 million, not 2 million, is basically balderdash.
And Dory, to that point then, a lot of people were just now getting into the thick of earnings season. Have there been any bellwether earnings so far that you think we should be keeping an eye on?
Well, I think this Netflix one was a big one. They've had a couple of big misses, and then with the stock going crazy today, I was very curious to see how that turned out. I guess it's less bad, as George pointed out. I'm really watching the banks. The banks are the plumbing and wiring to the economy. J.P. Morgan, increased reserves and said some deposit runoff. But all in all, credit quality is pretty good, trying to be conservative. And all the other banks actually have reported better from there. That is a really good sign in a recession. George mentioned the consumer, but I'd like to add on to that, the credit side of the recession. As long as credit hangs in there, we're in for a mild storm as we pile on to his metaphor. So we're watching the banks is very, very key here going for the next 3 months.
All right, Dory Wiley, George Ball, thanks so much for joining us this afternoon.